and welcome to Chapter 3. In this first part of a two-part series in Chapter 3, we're going to be talking about investment information and security transactions. Now, this chapter is important if you plan on opening up a brokerage account, buying and selling stocks, or looking for information to help you research stocks. Now, of course, there's a lot of availability in material to consume when you're looking to conduct investment research. Now, the internet has been a great resource for a lot of free or low-cost information about stocks. And the internet has also greatly reduced the amount of commissions for trading securities. Previously, security commissions were, if you go back to the 60s and early 70s, inflation adjusted around $100 or more a trade. They're moving into the 80s. They become close to $35 a trade, and then moving into the 90s, under $10 a trade, and moving into today, where a lot of individual stock trading is commission free. Now, the access to tools for traders, some of those we'll go over in this chapter, but we want to give you a getting started guide to doing some investment research and also some pros and cons of excessive internet trading. Okay, so investment research, there are a lot of sources, including the textbook that's associated with this course, and many other published books and textbooks available on investment education. There are also plenty of educational websites where you can go to Investopedia, the Motley Fool, the Khan Academy, just literally hundreds of sites that offer articles, tutorial, online classes talking about investment and investment education. The investment tools that you can be offered through the internet, of course, there are planning tools, how to develop budgets, financial plans, set investment goals. There are screeners where you could screen stocks and narrow down the selection of stocks that you want to buy based on criteria. That's useful. There are websites for charting. Now, we get into fundamental and technical analysis later. The technical analysis part will talk more about the utilization of charting and plotting and using charts to help predict stock price movements. And of course, you can get stock quotes on many, many websites. And there's also portfolio tracking. Keep track of your investments that you've obtained in a portfolio. And you could, usually your broker would do this for you, but you can also make what if portfolios, say on Yahoo Finance, and keep track of these portfolios. Now, as far as some tools that are available, they give you an example of a website here. Now, on this site, they have financial calculators, which you could look up in a search bar, any of these, and you'll probably find multiple websites that offer calculators to calculate your mortgage, your car loan, housing affordability, rent calculator, auto loans, I think I mentioned that already, interest, savings calculator, compound interest calculator, loan calculators, tax and salary calculators, retirement calculators. So this is a good little website to go to review and use these already mathematically proven and set up calculators to help you make decisions in your financial life, including the 401 calculator, IRA calculator. Very good stuff here to kind of help with tools for calculation, which will aid in your planning. Now, there are many different stock screeners available online. Yahoo is a stock screener. Zacks here has a stock screener, and most of them work pretty much the same way. I mean, if you just go into the Google search bar and you type in stock screeners, you'll probably get about 50 sites that will help you screen stocks, and you can kind of look through them to see which ones are the most user-friendly, that would work the best. But basically how these sites work is that they give you criteria, and then you set up a minimum, a maximum, or greater than, less than, or equal to the criteria that you want to screen the stocks by. So if you're looking for value stocks or growth stocks, or you can set these, or dividend stocks, you can set all of these different parameters to what you think would be a stock that you're looking for to fit your financial goals. So stock screeners are a good way to play around and get an idea of stocks that may be currently undervalued, stocks that have high growth in sales or earnings, things that can kind of put a group of stocks together. Then you can take your research into more detail later on. So it's always fun to look around and play with these stock screeners. Now, some word of caution about the internet. There's been a lot of talk about internet trading, which I'm going to say is going to include trading on apps. So when you trade so quickly and can trade multiple trades with zero cost, there is going to be risk involved. So even though you're investing, if you're going to be investing in short-term trades, day trading, or trying to make small amounts of profits, 25 cents, buy 1,000 shares. If it goes up 25 cents, sell it, make $250. These types of trades are more like gambling and speculation and very risky. So you want to exercise caution, and you don't want to. The secret to doing well in trading is not to trade too much. Trading too much is going to incur additional tax costs at higher rates. It's going to expose you to potential losses, and you may miss out on some very big gains later on. For example, my biggest example here could be is split adjusted. In the year 1999, I purchased Apple for $3 a share split adjusted. Now, if I held that till today, you could see how much money I would have made, since Apple is well over $100 a share. Now, when the stock doubled, when Apple doubled from $3 to $6, I sold it and thought I was very smart. But you could see how I messed up there. I also did the same thing with Tesla. I had purchased Tesla around $60 a share, and when it reached over $300 a share, I sold it, giving up massive amounts of gains later on. If I only had waited another 18 months, I could have tripled that. So these are examples of, investing for the long term with great companies with great management will far outperform these small short-term trades you might be tempted to make on the internet market. So you also have to be skeptical of any free advice. So when you're trading in a discount brokerage using an app or a discount brokerage, there's going to be no broker to help talk your investments through or caution you on investments as a safety net. But there will be probably a lot of free advice shooting around the internet in form of articles, in form of direct email information. But you got to be skeptical of this free advice. Why are they trying to push the stock? What did they gain from it? Is it just really for them to get more clicks and more views? And maybe the advice is just clickbait. A lot of times I'll see many YouTube videos or articles about how the stock market's going to crash. That's clickbait because no one knows when it's going to crash. So you got to be careful of what the advice is because it could be misleading. Now you want to know who you are buying from. So you want to make sure and we'll talk more about this later, you're using a reputable app or broker who's not going to manipulate you or falsify information to get your information and just be a scam, And you want to watch out for apps that have a history of manipulating things when they feel it's in their best interest, such as there was one app that prevented traders from selling a stock when it became too volatile, and that left a lot of traders very upset. Recently, there was an app, I think it was Robinhood, that prevented people from buying more shares of GameStop, and the reason why they did this is still not clear cut. So these would say that some of these brokers, I would be leery of them. I'd go more with like a Fidelity or Charles Schwab, a broker that has a discount broker that has a long history of being, having good services and good functionality. Now you want to watch out for, of course, any platform that's going to have a high transaction costs, in your trades, because you should be able to, depending on each broker, qualify for low cost or free trades. And you also want to make sure that you keep an eye on your short-term and long-term gains, because you're going to have much higher taxes on your short-term gains. And beware of the risks of margin trading, which we talked about some of this in the last chapter. Trading on margin could be very risky because you're now employing leverage. So now, there are two types of information that you can get. There's descriptive information, And descriptive information is usually my favorite. This is going to be factual data based on past performance of the economy or financial markets or an industry or a company, or a specific financial instrument. So descriptive data is just the facts. And then I use those facts to help me with my analytical process to figure out, is this a good buy, a bad buy, good investment? Now, the analytical information, this is available in conjunction with the current data, but it's some sort of projection, recommendation, opinion about potential investments. So be aware of the type, who this information is coming from, what the source is. There are some sites like Seeking Alpha, which will let just about anybody write an article. So there could be misinformation. Not everything is properly fact-checked. There could be misinformation. There could be the analytical information could be cited in a way that may not be the best advice for you. So be very careful when listening to other people's opinions. It's always best to draw and create your own opinions and your own thoughts. Because oftentimes when I very rarely found anybody's advice or information on the analytical side or their opinions to be correct. Oftentimes, I say 9 out of 10 times they're wrong. So that's why you don't want to necessarily trust that analytical information. Now, here's a report. I know you can't really see this, but this would be a descriptive report where this is from actually Yahoo Finance, and it's just showing you, I'll make it a little bit bigger here. It's just showing you the specific valuations, assets, sales, PE, 52-week high and low. This is just all descriptive information that you can get from many sites. Like Yahoo Finance is a good site for descriptive information. And then below descriptive information, they'll give you some analytical information in the posting of news articles below the stock quote. Now, sources of information, there are a few different sources of information. Of course, you have the economic and current events information, which is about news about how the economy is doing or current events in the world. There's industry and company-specific information that's specifically about a particular industry like semiconductors and a particular company within the industry like Intel. There's information on alternative investments. New investments are coming about all the time. Our new investments with new bells and whistles are coming up, and you may want to be abreast in some of these alternative investments to add to your portfolio. Price information, which is a quote that can be found very easily on many websites. Some websites might have the quotation of the stock price in a 20 minutes delayed, and some websites may be real time. So you just want to keep an eye out for that. Information on personal investment strategies. So there are a lot of websites that will push out articles and information about strategies for personal investment, which are good. Now, sources of information, three great sources for economic and current events of the financial journals would be the Wall Street Journal, which I usually leave a link on the electronic blackboard where you could get a very inexpensive subscription to the Wall Street Journal. If it's not there, just email me. And the Wall Street Journal is a great daily paper published Monday through Saturday that reviews all of the market news, the world events, regional events, corporate news, and how it impacts stock prices. So the Wall Street Journal is sort of like part newspaper, part financial news, with heavier emphasis on financial news. Now, Barron's is a weekly publication. I think it's published on Saturdays, and it's a very credible source, and it's a more in-depth review of financial markets and the performance for the week, and then they highlight articles and information. It could be on a company, it could be on a particular economic event. Also a very good paper. Now, the Investor's Business Daily is a more stock-centric focus paper that's going to list stock prices, market data, and it's going to be very specific on all things the stock market. They even have their own curated list of stocks and ratings for stocks. So the Investor's Business Daily is the most expensive, but probably the most detailed and useful of the three types of financial journals. Now, there's also institutional news. So there are news feeds that come from governmental sources such as the Federal Reserve and other governmental agencies that will release economic news. There's also these wire services, which are news services like Dow Jones, Bloomberg, AP. They will release news, and you could sign up email to get their news releases. That just basically breaking news, not very in depth, but just very cursory. This is what's happening. And then, of course, there are the websites like MarketWatch and CNN Business, where you can get financial news. Now, there are business periodicals, which are basically a fancy way of saying magazines. So there are magazines like Business Week, Fortune, Forbes, Money, The Economist. And these are all great magazines that are going to focus a little bit more in depth in corporate finance and companies, as well as financial markets and economics. So these are also, and since these are published either in a monthly or a weekly format, they tend to be a little bit more detailed. One of my favorites is The Economist. It's a English magazine, a very detailed, very high level economic analysis about the world. I find that a very interesting read. Fortune is good for a lot of in-depth company information, I would say. And Business Week, just overall analysis of weekly business news. And these are how, this is how you know you're someone who's interested in business, investing, in finance, if you like reading these publications. If you enjoy going to financial websites, looking up data, reading articles, if you enjoy these business newspapers or magazines, then you sort of have a passion or interest for business, and you should do very well in investing or in business or owning a company because you have a natural interest for business and what's happening in the business world. If you find these newspapers or magazines or news releases boring and not interesting to you, then you might want to rethink your career or rethink being an active investor, because first of all, you really need to have that passion about investments and finance to do very well in the area. Now, there are government publications, Economic Report of the President, Federal Reserve Bulletin. There are the Department of Commerce, the U.S. Census. These companies all bring out federal reports that are free. You can find them online just by doing a Google search. They're a little dry. You really have to put the work into it to get good analytical information to decide on analytical use of the data. But nonetheless, they're pretty useful to get the original source. Now, continuing with the sources of information, we have company and industry information. So trade publications, which are periodicals to a specific industry, can give you a lot of detail about specific industries. So these are like very niche types of magazines. They're going to focus on one industry and the problems of that industry. Many of these are online distribution only. But if you're interested in investing in a certain area, maybe you're interested in companies that make video games, companies that are going to make hemp or cannabis products, semiconductor companies, software companies. You could, get these periodicals and learn more about the industry, what's happening, who are the movers and shakers, who are coming up with new ideas. And of course, like we talked about before, they're the general business periodicals, Wall Street, Business Week, Forbes, Fortune. And of course, you can get a lot of information from company websites. So company websites are a great resource to get investor information, annual reports, filing, press releases, many of which you may not find in any other source. Also, if you know companies that you like and companies that you think you might want to work for, the website's probably the best place to get information about careers. And one of the best strategies is that you go to a website, you go in careers. If you apply through the website, you may be actually applying for a job that hasn't been mass advertised yet in the job sites. So you may only be one of a few people applying for the job. And if your credentials are good, they may hire you, save the money of advertising the position, and that way greatly limiting the amount of candidates that you have to compete against. Okay. So other online sources and company data information. Hoover's is a great source. They have a free section and a paid section, and they have many good reports and information on companies that you could get. when you for the paid service, you should be able to download specific data on companies. It makes researching individual companies and industries very easy with Hoover's Online. Also, you have CNET, which is another good site for high-tech analysis and breaking news. Yahoo Finance, which is a very user-friendly site for building portfolios, getting stock quotes, getting stock profiles, getting market data on stocks, analyst ratings, insider trading. Very useful platform, Yahoo Finance. MarketWatch is great. This is a good platform for getting news on the industry, reading specific articles about the market, and information on companies. Okay, now there is this law called Regulation FD, which means Fair Disclosure Rule, which means that companies that release information have to simultaneously release it to investment professionals as well as the public. Prior to this Regulation FD, it wasn't uncommon for companies to release information directly to analysts and not individual investors. So this was really unfair and made analysts or stockbrokers in some cases have some valuable information that helped encourage people to work with them. Now that everything is released simultaneously, it's a lot fairer. You don't have to rely on an analyst or a stockbroker to get that information for you. Now, the Stockholders report is the annual report a company releases. This is also very useful. It has a management section, the management talking about the company and how well the company's doing and how well the company should be doing moving forward. It has all the financial reports in it and a lot of other useful information to help you decide whether the company's on the right track or the wrong track. There's also a filing called the 10K, which is an annual statement a company's file with the SEC that's going to be, if you're publicly traded, you need to file this 10K, which is, again, an annual statement involving the finances of the company. And there are plenty of websites where you could get these reports that are filed with the SEC. Freeagre.com is one of them. Now, the company's website generally has the annual report as well. And that's probably the best place of getting it. And they may actually have multiple years of the annual report. Now, comparative data, as far as comparing sources of data, Dun & Bradstreet does a good job of comparing key financial ratios of different businesses. So there are some websites, Hoover's is one of them also, that you can get comparative data across many industries or companies. Now, this is a page from the Procter & Gamble's shareholder report. And you can get the most up-to-date report using this link or just going to Procter & Gamble annual report search, and you'll come up. And you can see that the annual reports are flashy. They're almost a sales tool. They want to encourage you to buy the stock. So they really try to do their best in presenting the information and explaining the information to average shareholders. So if you believe in a company, you should always get the annual report and review the annual report. I would say also, if you have a big investment in the company, generally a lot of companies on their company website will invite you to the quarterly meetings and annual meetings where you can listen in and even ask questions sometimes about the company from the top management of the company. Now, continuing with other sources, there are subscription services you can get. Now, these are expensive and generally for people who are in the investment market, making money as an analyst or a broker or a personal investment advisor. And these, Value Line, Investment Survey, Standard & Poor's Corporation, they do have these subscription services, but they can run into hundreds and hundreds of dollars. Very expensive. But typically, it's expensive because you're getting research not available freely to the general public. There are brokerage reports. So brokerages will put together reports on different companies and different mutual funds or investments with recommendations. And if you have, the more you get closer to a full service broker, the more of this information will become useful and the more you'll be able to get for free. There are investment letters these are like newsletters based on a subscription basis. So some very famous traders or some very famous analysts might put out personal newsletters about the market and investments they recommend. Some of these letters can be $500 to $5,000 a year subscription costs. So they're very valuable and useful types of investment information. But the average investor is not going to pay for this. This would have to be somebody who really believes in the person writing this investment letter and has made a lot of money from it in the past to take advantage of this. Not for the average investor. Okay, price information. Quotations are probably the easiest thing you can find as far as information about stocks. Just about probably well over 500 websites will give you the ability to type in a stock symbol and get the quotation information of a company, which is the current bid and ask of the company. Now, the key thing is you want to be able to get real-time quotes. Some websites will give you 20-minute delay quotes, and some websites will provide real-time quotes. So you want to make sure you know if you're getting the delay to real-time. You'll always specify. Other online investment sources could be financial portals that are created specifically for personal finance. We talked about, there are many such portals. There are specific sites just for bonds, specific sites just for mutual funds, sites for international investing, and sites for investment decisions, and forums for investment decisions where investors can exchange opinions on stocks and investing strategies. There are Reddit groups, Facebook groups where investors are getting together and sharing information, and in some cases rolling the markets back and forth based on the power of the small investor. Now, generally, if you want to find information about a company, you need to know the company's stock symbol. And for most stock quotes, they will give you the ability to also look up the stock symbol by typing in the company name. And a lot of times the stock symbol is very close to what the company name is, or part of the company's name. So when you become a more experienced investor, you'll probably have a lot of these stock symbols memorized. Now, here's a bad sign. If someone's giving you advice or talking about a stock and they just can give you the stock symbol, but they don't know the name of the company, that's probably someone you don't want to do business with. So make sure that you're not trading on stock symbol alone. You actually know the name of the company and you actually have done some research before you buy or sell any types of companies. But the entry point to making a trade is the stock symbol. Without the stock symbol, you can't buy or sell the company. So here are a few websites that are going to provide investing information. Some of these, all of these we talked about already. This is just a recap of these websites that you could, and this is what you should be doing during this class. You should be going to these websites routinely, looking up today's news. They usually have a mix of today's news. And as you build sample portfolios or you look stocks up on these websites, they start delivering you more specific news on the stocks that you're interested in. So these are a great way to keep on track of your stocks, your portfolios, your investing ideas, and what's happening in the markets. Highly recommended that if you're going to be a serious financial person, and especially if you're going to work in the investment area, that you need to have a daily routine where you spend at least 15 to 45 minutes a day just catching up on the current news. Now, and of course, there are sites if you're interested in investing in bonds or interested in treasuries, which we'll go over more in later chapters. Now, there are these other popular websites: Morningstar, Mutual Funds, Investor Center, Max Funds. So these are sites that will help you better digest mutual funds and quotations on mutual funds, performance on mutual funds, news about mutual funds, ratings on mutual funds. So a lot of you may not invest in individual stocks, but many of you will be purchasing mutual funds at least through your 401k as you get a full-time job. Okay, so you want to avoid scams and you want to avoid people trying to manipulate you. So in the stock market, unfortunately, there's been a long history of bad behavior, and the internet can make some dangerous environments for investors. So you want to be aware of stock manipulators, people who provide false information or people who have overly optimistic opinions about a stock. And this is probably because they have some kind of financial interest in the stock. So you want to know who your source is. And a very common campaign is this pump and dump campaign, where promoters will try to hype up a stock, get people to buy it, move the price up quickly, and then turn around and sell it. before the rest of everybody else sells it. So this is something that you want to be careful of, that if you get in the middle of this pump and dump, someone doing this strategy. Now, the SEC will actually take legal action if someone's doing a pump and dump and they're trying to pump the stock up with false news or lies or misinformation about competitors. This could get them in jail. So, but you just want to be careful. You don't want to buy any stock too quickly. You really want to do your research and double check your sources and the prospects of the stock before you jump in. Or if you have a group of people that you can trust, you've invested with before, and their advice is reliable, things you want to look for. Be very careful of anything that's trying to promote a get-rich-quick scheme. Anybody or any article or any website that's trying to promote to you, buy the stock, you're going to get so rich, it's going to go up 10 times. So a lot of times they're promoting worthless investments, and they're just maybe trying to get advertisement revenue on websites or on videos, so you got to be careful of anybody that's making claims of strategies of how you can quickly get rich in the stock market. Doesn't work that way. Stock market is not a get rich quick type of financial instrument. It's more like get rich slowly. Okay, so the Commodities Futures Trading Commission has some advice. Basically, they say don't purchase digital coins or tokens based on a single tip. Especially if that tip comes from social media. So be careful when looking at digital coins or digital currencies. Be skeptical about ads or websites that promote ideas that can get you rich fast by investing in cryptocurrencies. So I'm not saying cryptocurrencies are bad investments, but I'm saying there are a lot of bad or fraudulent websites that in some of the worst cases may actually take your money and pretend that they sold you a cryptocurrency, that really they sold you nothing but a scam. So you got to be careful in this wild west of cryptocurrencies that you're buying a cryptocurrency from a legitimate source where you're going to actually have the proper code keys and actually own the cryptocurrency. And you got to be very careful with cryptocurrency, because if you lose those code keys, you've lost the cryptocurrency. And there's been plenty of people who've had 100 shares of Bitcoin, but lost the thumb drive or the computer where the passwords and keys were kept. And remember that no investment is guaranteed. So if anybody tells you that an investment has zero risk or it's a guaranteed moneymaker, probably should stay away from that investment, as a word of advice. Me personally, anytime I took somebody else's advice, I usually lost money. Anytime I invested on my hard work, my analysis, my observing of the stock markets, I did well. And that's one of the first lessons I learned, is you can't take a shortcut by following other people's advice. And one of the reasons is you may have got that piece of advice last, so everybody else has already traded on it and pushed the stock up. So even though it might be good advice, the timing of when you get the advice matters too. So you want to study the performance of the market and market averages and indexes. You want to look at how do these indexes and averages react to certain news, certain change in presidency, economic news, wars, crisis, famines, disease, big economic events. How does it react when the company releases information about stocks? But generally, the market averages and indexes will give you a good idea of if the market's in the bull or bear market. And then you can compare your personal portfolio performance to that index or average to see how you did compared to just the averages. So also looking back and studying the historical performance of these indexes and averages after market crashes and bull markets and just the overall direction gives you a better understanding of the behavior of stock markets and the likely future direction of stock markets. Now, we will be going over stock market averages and indexes, and we'll be talking about bond market indicators. These are all things that help get you a better understanding of the direction of the market and maybe even give you some idea of when the best time it might be to invest money. Now, when we say market averages and market indexes, they're actually two very separate things. A average, like the Dow Jones average, reflects the arithmetic price behavior of a group of stocks in a point of time, where an index, like the S&P 500 index, measures the current price behavior of a group of stocks in relationship to a base set value at an earlier point. And this will become important later on in the class. So let's talk about the Dow Jones Industrial Average. So the Dow Jones Industrial Average is probably the most well-known average. It's a group of 30 of the biggest stocks. So these are well-respected, well-known companies that are scattered between many different industries. This is the index that we'll see most often cited in news stories or articles in magazines. And this is price weighted. So stocks with the higher price have more influence than stocks with the lower price. But the price weighted is sort of a fail because it doesn't really relate to the total value of the company. So there could be a stock with a low share price with a huge amount of outstanding shares that is a much bigger company than a company with a high share price with very few outstanding shares. So both together, outstanding shares and the stock price are used when they're multiplied each other to create the market capitalization. So price weighting already distorts the influence of some stocks over other stocks in the average. Now the stock makeup does change over time as companies merge. Some companies go bankrupt. Some companies are just clearly kicked off the exchange and replaced with new companies. How the Dow Jones Industrial Average is calculated, there's a formula where we add up all the stock prices together and we divide by the Dow Jones Industrial Average divisor. And this gives us the amount of the average. And the divisor is calculated by the Dow Jones Company. And in a separate lecture, I'll show you the mathematics of how to calculate this in a spreadsheet. Okay, so stock market averages and indexes. So the Dow Jones has not just the Dow Jones Industrial Average, there's also the Dow Jones Transportation Average, which is 20 of the biggest transportation stocks. They have a Dow Jones Utility Average, which is the 15 biggest publicly traded utility stocks. They have a Dow Jones Composite Average, which is made up of 65 stocks, which is the 30 industrials, the 20 transports, and the 15 utilities. So the Dow Jones Composite Average is probably a better overall look at how the stock market is doing than any one of the individual averages. So the Dow Jones, they also publish the total stock market index. They have indexes for various sectors based on company size, small cap, mid cap, large cap, indexes for global equities, the emerging markets. So any way you could slice and dice a group of stocks, there's probably some index or average out there to look at their performance. Now moving into the Standard & Poor's, which is an index. So this index, it works differently. So we're going to look at the capitalization, the closing market capitalization of each stock divided by a divisor. Now, the formula is a little bit more complicated than this. Again, I'm going to show you in a separate lecture about how to use this, how to calculate this in a spreadsheet. And what we're doing here is we're going to reflect the stock price and the amount of outstanding shares and the company's performance over time. So the S&P 500 index is a more broad-based, more representative, closer to the truth of the changes in the market. Now, so the Dow Jones is only 30 companies, where the S&P 500 is 500 companies. So it's a much broader look at the market and the market's return. Now, the S&P 500 is a look at large cap companies. So it's 500 of the largest companies. But the S&P 500 also have other indexes. They have the S&P 100, which is the top 100 largest companies. They have S&P 400, which is the mid-cap index that looks at 400 of middle-sized companies. They have the S&P 600, which is a small-cap index on the 600 smallest companies. And there's the S&P Total Market, which is going to comprise all stocks listed in New York and NASDAQ stock exchanges. So this gives you an even broader market sense of how things are going. So here's a look at, this is the Dow Jones Industrial Average from June 1st, 2016 to 2018. So it's not current, but you could kind of see the overall upward trend, a little bit of disruption here in 2018. and then moving towards the end of 2018. And then in 2019, 2020, we get a big disruption in 2019. We get some big fluctuations in 2020 and 2021. So you could go Yahoo Finance and you can type in the Dow Jones Industrial Average, and you could make your own charts in any time frame you want to really see the gains. But here we're actually putting, there's two indicators here. The dark blue here is the Dow Jones Industrial Average, and the light blue is the S&P 500. So you can see how they're tracking pretty similarly together if you look at the two together. So during this period, the Dow Jones gained 38% and the S&P gained 30%. So they're not identical, but you can see they kind of move in a similar pattern. Okay. So we're going to pause the lecture here, and we're going to start part 2. We'll start on this slide, and we'll continue with understanding market averages and indexes in part 2 of this presentation. Thank you for your time, and I'll talk to you soon.